In this lecture, we will continue the discussion on depreciation accounting. This is part 2 of that series. We will first review the classical depreciation methods, those that were used in the United States before 1981. And then we will compare some examples, specifically with respect to the cash flows after taxes. So you might ask, well, why study the classical methods? Well, there are several reasons. One important reason is that the classical methods must continue to be used on assets that were acquired before 1981. Another very important reason is that the classical methods form the basis of modern methods. And if the tax law changes, as it does about every 3 or 4 years, then there's a good chance that understanding of the classical methods will help you understand the new modern methods. And of course, the classical methods may come back as options in the modern methods. The third reason is that the classical methods may be used in other countries. We'll review 3 methods here: the straight line method, the sum of the year's digits method, and the declining balance method. The third is actually a family of methods. 2 important members of that family are the double declining balance method, DDB, or 200% DB, and the 150% declining balance method, or 150% DB. In this series of examples, 3 through 5, we will examine a 5-year project with revenues anticipated to be $28,500 per year. Labor and materials are estimated to be $5,000, and we're going to allocate $15,000 loss in value of equipment. We're going to assume the company buys equipment for $20,000 at the beginning of the project and then sells it for $5,000 at the end of 5 years. The income tax rate is 40%. That may be a combination of federal, state, and local taxes. So that's our marginal tax rate. And in addition to obtaining profit after tax, we're going to take a close look at the cash flow after tax. Let's review the straight line method and introduce some symbols. We need to know the basis, the installed cost of the asset. We call that B0. That includes taxes and freight. And we will assume in these examples that there is no trade-in value. We usually obtain the depreciation life, N sub D, from tax agency guidelines. And we also need to have some estimate of the salvage value, which may be based on past data. If there is no past data for the equipment type, then we set the salvage value at 10% of the original installed cost. And with the straight line method, the depreciation each year is simply the anticipated loss in salvage value, purchase price minus estimated salvage value, divided by the depreciation life. So in this example, example 3, the straight line method allocates the same amount, $3,000 per year, of depreciation. Each year the depreciation is the same $3,000, and we see in the graph the book values declining from $20,000 to $17,000 to $14,000 to $11,000 to $8,000 and then to $5,000, which equals the estimated salvage value. We also note that the time scale for the graph represents points in time, starting out with time point 0, the beginning of the first operating period, and then below that we have another time scale for this example, and those are the periods of time or the accounting years. In this portion of the table, for example 3, we've taken the revenues, which were $28,500, subtracted from that the labor and materials expenses to get what we call operating cash, and that's $23,500 for each year of our example. To obtain taxable income, we subtract from the operating cash the equipment depreciation expense. That's $3,000 each year, giving us each year the same amount, $20,500 taxable income. We then apply the 40% tax rate to that, giving us the income tax each year of $8,200. Profit after tax each year is $12,300. To obtain the cash flow after tax, we need to reflect that the profit after tax includes in the computation a minus $3,000 for equipment depreciation. And we need to undo that arithmetic operation. In other words, we take the $12,300 profit after tax each year and add the equipment depreciation expense of $3,000 to get $15,300. We also need to remember that we spent $20,000 investment for the equipment at time zero, and that we get proceeds of $5,000 at the end of the fifth year. In this example, we only claimed $15,000 total depreciation expense for the 5 years. We didn't claim the $5,000 that we're getting as a proceed. So all of the $5,000 proceed is pure cash. That's not subject to tax in this particular example. And then for convenience, we have the column totals. Let's look at the second method, the sum of the year's digits method. That's an accelerated method. The basis, that is the original installed cost for accounting purposes, the estimated salvage value, and the depreciation life are the same as for the straight line method. The method is quite simple. We first obtain a sum of the integers, which represent the number of years from 1 to the end of the depreciation life. We take those integers and simply add them up. And then we apply fractions with those same integers, but in the reverse manner. We take the integers, 1 up to the depreciation life, divided by the sum, and apply that to the anticipated loss in value of the asset. It's actually easier to explain this with an example. So here in example 4, we're going to apply the sum of the year's digits method to the asset of $20,000 with an anticipated salvage value of $5,000 after 5 years. So the depreciation life is the same as it was for the previous example. We take the integers 1, 2, 3, 4, 5, 5 being the depreciation life, add them up to get the sum. That's 15. Then we're going to take those same integers and with the sum create fractions which will then apply to the anticipated loss in value. So the first fraction is going to be 5 over 15. This integer divided by the sum. We apply that to the estimated loss in value, 15,000, to get the first year depreciation of 5,000. The second fraction will be obtained by taking this next integer in reverse sequence, that's the 4, and dividing it by the sum of 15, and then applying that to the same anticipated loss in value. So the year 2 depreciation is going to be 4/15 times 15,000. That's 4,000. In the third year, of course, we would have 3 over 15 times 15,000, or 3,000. In the fourth year, it would be 2/15, and then, of course, in the last year, it's 1/15. We then enter these amounts in the table, but here first let's have a look at the graph. Notice that the depreciation varies because we have an accelerated method. We have more depreciation in the early years in contrast to the previous straight line method. We also see the book values declining to 15,000, 11,000, 8, 6, and 5,000. Again, the last book value agrees with the estimated salvage value. And here in the table, we've entered the depreciation amounts, the 5,000 in the first year, 4, 3, 2, and 1. The operating cash is the same as it is for example 3 because it's the same project. We're anticipating the same revenues, the same labor and materials expenses, and so forth. Subtracting the equipment depreciation expense from operating cash then gives us our taxable income, which varies in this example now. And then we apply the 40% tax to get the tax in the fourth column, subtract the tax from taxable income to get profit after tax. In year 1, the profit after tax is $11,100. It climbs to $11,700, and so forth. And to get the last column, the cash flow after tax, we again take the profit after tax column and undo the arithmetic operation of the subtract for the equipment depreciation expense. In other words, we take $11,100 in year 1, add $5,000 equipment depreciation expense to get $16,100. It's cash flow after tax in year 1. In year 2, the profit after tax is $11,700. We add $4,000 equipment depreciation. That gives us $15,700. And then, of course, at time 0, we have the $20,000 investment for the equipment. And at the end of the fifth year, in the last line, we have the proceeds from the sale of the used asset. Again, we only claimed $15,000 total equipment depreciation expense. So the $5,000 proceeds is for part of the asset value that was never claimed as an expense. So that portion is not subject to tax. That's pure cash. The sum of the cash flow after tax column, 61,500, is the same as it is for example 3. So is the profit after tax. That sum 61,500. And the sum of the profit after tax column equals the sum of the cash flow after tax column. Now let's look at the declining balance method. This again is an accelerated method. In order to compute this, we need a multiplier. That's based on the tax law, typically either 2 or 1.5. The bases, the estimated salvage and the depreciation life, are the same as for the straight line method. In our example, we're going to use the double declining balance method. So we're going to obtain a multiplier m equal to 2. We obtain a multiplier a by taking this 100% times 2 or 1.5 or whatever the case may be and dividing it by the depreciation life. We then apply this a multiplier to the book value year by year. As the book value declines, we apply the a multiplier to that. We have to take care that the book value does not decline below the estimated salvage value. Let's apply this to the example. The multiplier is 2. That's 200% then divided by the depreciation life of 5. So that gives us our A multiplier of 40%. So 40% times the original installed cost, 20,000, gives us a whopping $8,000 depreciation in the first year. That's much larger than the other situations. We then take this $8,000 depreciation and subtract it from the book value times 0 to get the book value time 1, which is 12,000. This subtraction process actually works for all of the depreciation methods. We didn't explain that for the others, but here it's important to show how the subtraction process works. Then we take this 12,000, apply to that the 40% multiplier to get the year 2 depreciation. That's 4,800. Then we subtract the 4,800 from the $12,000 book value to get the new book value of 7,200. And that will then be applied with the 40% multiplier to get 2,880. But we have to be careful here. We have to be careful not to let the book value drop below the estimated salvage value. And our estimated salvage value in this example is 5,000. So then we have to go back and modify the third year depreciation so as not to have the book value times 3 go below 5,000. In the graph we show that. We show this whopping $8,000 year 1 depreciation, then the 4,800 depreciation in the second year. Book value drops to 12,720, and we show that we have modified the year 3 depreciation so that the final book value equals the estimated salvage value. In this example, there is no depreciation in years 4 and 5 because to apply depreciation would drop the book value again below the estimated salvage value, something that we're generally not allowed to do with this method. So let's enter these depreciation expenses then and apply them to the operating cash to get our taxable income. Again, notice that in the 4th and 5th year, there's no depreciation because we've already reached the estimated salvage value. Then in the traditional method, we apply the 40% tax to get our profit after tax. The cash flow after tax is again obtained in the same manner. In the first year, 9,300 profit after tax. Add back the 8,000 equipment depreciation that was used to compute the profit after tax. Remember, the $8,000 equipment depreciation is not a cash flow, and because it is represented in the 9,300, we need to undo that arithmetic to get the cash flow after tax. So in the first year, the cash flow after tax is 17,300. We do that also in years 2 and 3. In years 4 and 5, there is no equipment depreciation expense, so the cash flow after tax is numerically equal to profit after tax. Again, at time 0, we have the investment, $20,000 for the equipment, and at the end of the 5th year, we have the $5,000 salvage value. Again, we only claimed $15,000 total depreciation, so this $5,000 is pure cash. That's not subject to tax. Here we have a graph showing the three different methods. The solid line is the straight line method, 3,000 each year. The middle dashed line is the sum of the year's digits method. And then the lower dashed line, DDV method, the double declining balance method. For all of these methods, the ending book value is equal to the estimated salvage value. That's a characteristic of the classical methods. Now let's go on to a more detailed comparison of the cash flows. And we'll first look at a comparison between examples 3 and 4. We notice that the equipment depreciation expense is the same. It's $15,000 for both examples, but the timing is different. And it's this timing of the depreciation expense that causes the difference in the cash flow. Here we have $3,000 versus $5,000. $15,300 cash flow after tax versus $16,100. The investment, the $20,000, is the same for both, and the proceeds, the $5,000 from the sale of the used asset, are the same. Cash flow after tax sum is the same for both, $61,500. And if we insert the values for example 5, we see again that the sums are the same. The sum of the depreciation expenses is $15,000. The sum of the cash flow after tax is $61,500. The difference, of course, being in the timing of the cash flow. Among these three situations, then, all other things being equal, most people would prefer the double declining balance method because it provides a faster cash flow after taxes. And we can compare that using net present value, for example. We can compute the net present value of the cash flow after taxes for both examples 3 and 4. For example 3, the net present value of the cash flow after tax is $33,774. In example 4, it's $34,146. That's a difference of $372. We can also do that for the depreciation. Compute the net present value of the depreciation expenses. That leads to a difference of $930. And then we might ask, well, is there a relationship between these two numbers? It turns out there is. In this example, the marginal tax rate is 40%. And in this example, the marginal tax rate remains the same for all 5 years of operation. So in that situation, applying the marginal tax rate to the difference in net present value of depreciation amounts gives us the difference in net present value of the cash flow after tax amounts. When we extend that comparison to example 5, we find a similar result. Here we're showing a comparison between examples 4 and 5. The difference in net present value of depreciation amounts is $1,047. The difference in net present value of cash flow after tax amounts is $418. And again, we obtain the 418, or we can reconcile the 418 by the 10,047 multiplied by the marginal tax rate. So this shows the advantage of having accelerated depreciation. The more accelerated the depreciation amount, the greater the advantage is with respect to the cash flow after taxes. You get more of your cash earlier. And of course, other things being equal, most people would prefer to have their cash earlier rather than later. So we have a major observation, that is the net present value changes in the cash flow after tax can be traced back to changes in the depreciation pattern. And we have an expression for that where the marginal tax rate remains constant. We can apply this expression, take the net present value differences of the depreciation amounts multiplied by the marginal tax rate, and that then gives us the difference in the net present value amounts of cash flow after tax. So in summary, we have covered the classical depreciation methods, those used before 1981 in the United States. And these are the straight line method, the sum of the year's digits method, and the declining balance method, which is really a family of methods. And in our example, we have applied the 200% declining balance member of that family. And we looked at 3 examples where we compared the cash flows after taxes. We compared the effect on taxable income, and then the effect on the cash flow. And the only difference in the cash flow after tax was due to the differences in the depreciation methods, because the revenues and the expenses for labor and materials were the same in all 3 examples.